You ever wonder why stock analysts are so incompetent? So do we. Not all of them are bad, but in general, when they say buy, it is often time to sell. And when they say sell, it is often time to buy. Some are great, but most are symptomatic of a greater problem on Wall Street. That problem is beyond the scope of this video or even this channel, but let's just say it's bad and systemic. Welcome to Incompetent Capital, where accountability for competence on Wall Street is our top priority. Today, we will delve into one of recent history's biggest bloopers on analysts' behalf, the calls made on the Disney stock. Most analysts have gotten this wrong, and if anyone actually followed their stock estimates, they would buy high and sell low, and probably dish their savings out to make horrible calls that land them in a homeless shelter. Absolutely egregious. For example, Benjamin Swinburne of Morgan Stanley consistently destroyed the incompetence meter for this stock. If you look at his estimates from 2015 to current, you would have overpaid and undersold most of the time. Notice how Benjamin overbid the stock by $15 in early May 2021, and right before it began to tank all the way until 2023, he changed his estimate to 210 overweight. You can't make this stuff up, guys. Disney is about to tank from 185 to 169, and Benjamin is over there touting that it will go up to 210. Within the year, Disney tanked all the way to $84, and while Benjamin was wise enough to lower his estimates, he still overshot by an average of about $30 through this entire period. To his credit, he was pretty spot on calling the peak before this all happened, but he unfortunately made way too many disastrous calls after that lost people way too much money. Side note, before we delve and expose more of the incompetent analysts for the day, we think it is important to note that out of compassion for the incompetence being exposed, we rounded the figures down to avoid some pain for them on all decimal numbers, including the result. So if the numbers calculated were 108.8 plus 110.1, we did 108 plus 110, for example. And if the result after division and other operations had decimals, we rounded down again. So suffice it to say, the numbers are just a little worse than we are presenting, and we will continue this practice on this channel unless otherwise stated and agreed. Another culprit who blew away the incompetence meter on Disney is Brian Kraft of Deutsche Bank. If you look at the chart with both of them on there, you would think that Benjamin and Brian were both drinking whiskey together all year while they should have been crunching numbers and giving accurate estimates. It seems safe to say that both are just as incompetent in this matter. But that's not fair to Benjamin 100%, because as you can see, Bryant's numbers on the way down were way more bullish than Benjamin. Bryant held 190 all the way down to 110, where he changed to 131 and stubbornly held on to that as it continued to crash all the way down to 84. He even had the audacity to raise to 135. This led to an average overshoot of 19% and $28 in the said period. Our third culprit of incompetence is Vijay Jayant of Evercore. As you can see on the chart, Vijay's performance was in a similar range to Benjamin and Bryant, but we note two important differences. One, Vijay stubbornly held on to his ridiculous estimate of 190 until the stock was tanking around 110. And two, someone was smart enough to pull this guy from the project in 2023, as we see no more bogus estimates after that, at least yet. Or maybe he was just holding back to see what the stock does before he makes his move. In addition to Bryant, Benjamin, and Vijay, we found that Barton Crockett of Rosenblatt also destroyed the incompetence meter. Barton gets a half pass today though, because while he did increase his estimate to overbid the stock in a buy at 177 call in April 22, his previous 133 estimate was an underbid as Disney started to peak. Had he stayed on course and lowered, he would have actually been accurate in his estimates. But the whiskey party needed a fourth member to join, and out of compassion for the rest, Barton was a good friend and decided to drink with them instead of working. Our fifth and final defendant for the day is Stephen Cahall of Wells Fargo. He consistently made false bullish calls on Disney stock during the said period. Again, if you see the chart, you notice how horribly falsely bullish he was on this stock. I don't think we need to analyze numbers on this one. The proof is right on the screen. So consistent bad calls that lost people money, no public apologies from them or their firms, and this is being done across the board by everyone on Wall Street. Again, that gets into territory that is beyond the scope of this video or this channel, but for our purposes, suffice it to say that we found two patterns in what goes on here. One, most analysts act somewhat in accordance, and two, the calls they make are reactive to the stock price and not proactive calls based on fundamental analysis. This behavior of reacting to a stock is exactly why we say that these people are just going to work, opening their computer, collecting a drastically oversized paycheck to do absolutely nothing, and are then clocking in numbers that are reactive to the stock price, while in actuality, most of their time was spent drinking whiskey and snorting bad things. Disclaimer, we actually don't promote the idea that these guys are not doing their jobs and are partying instead, just saying that for entertainment. They may have just made a bad call, or 2 or 3 or 400, but what we notice is that they seem to be operating in aggregate, and as we see from the chart, this for some reason has become the norm for analysts. Everyone seems to be making the same bad calls, more or less. Not sure why that is. It is again a topic for another video and channel, but suffice it to say that these guys all make bad calls that more or less mimic each other in succession, leading to a bunch of bad calls. We find it shocking that these analysts have consistently overbid Disney stock during the said period. They ignored many fundamental cues that the market and overall economy was giving during the time, and that is of great concern for us. You see, between 2021 and 2023, Disney Corporation encountered significant challenges that led to a decline in its stock value. The consistent impact of the COVID-19 pandemic continued to disrupt Disney's operations, particularly in its theme parks, cruise lines, and movie releases. Despite efforts to adapt and recover, fluctuating infection rates and ongoing restrictions led to a lower than expected attendance and revenue, putting pressure on the company's financial performance. Moreover, Disney's streaming platform, Disney Plus, faced intensified competition from rival services during this period. This heightened competition strained subscriber growth and raised concerns about Disney's ability to maintain its market share in the increasingly crowded streaming landscape. Production delays and escalating content costs further impacted profitability, while uncertainties surrounding the sustainability of its streaming strategy weighed on investor confidence. Additionally, internal reorganizations and strategic shifts, including the departure of key executives and reassessment of business priorities, introduced additional uncertainty about Disney's future trajectory. These factors collectively contributed to a decrease in investor confidence and a decline in Disney's stock value from 2021 to 2023. And in the face of all this, a lot of the analysts covering the stock completely ignored the writing on the walls and stubbornly and bullishly overbid the stock. If you want to be a successful investor, there are two paths to follow: technical analysis or fundamental analysis. Technical analysis is analysis of the stock's behavior patterns and chart activity, while fundamental analysis is an analysis of the company's underlying fundamentals and financial position. So pick your pool, learn it, and practice with competence. Don't rely on others who are merely collecting a paycheck for advice. For if you do, you are also behaving grossly incompetently. If you like our content, please be sure to like, subscribe, and hit the notifications icon so you are notified accordingly. Thanks for watching, and continue to tune in to Incompetent Capital.